This 3 ETF portfolio has beaten any other that I have seen and consistently beats the stock market. Back in the 90s, they used to recommend that your 3 funds were bonds, US stocks, and international stocks. Now that has all changed for reasons that I can go into in another video, but basically the bonds were your safety net. The stocks in the US were your stability, but yet they would grow, and then your international stocks were your high risk, high rewards. Nowadays, that has changed. Me personally, I am using a 3-fund ETF portfolio that is consistently beating the market. And the way that I break that out is I have a foundation ETF, which tracks either the S&P 500 or the total US stock market. Personally, I invest in VOO from Vanguard for my S&P 500. And then I also invest in VTSAX, also from Vanguard, for the total US stock market. But there's so many out there, you can pick which one you like. Instead of bonds for safety, I want safety, but I also want cash flow. And so for this, I invest in dividend ETFs, which essentially will pay you money every quarter, or however the dividend is set up with the company. It will pay you a percentage of your holdings so that you never have to touch your principal investments. And this is a way to have passive income through the stock market. So I personally invest in SCHD from Schwab, but I also like VYM from Vanguard for this. Now, these are not sexy companies. These are slower growing. They are not going to be your crypto or your AI. We're going to get to that in just a second. But these are going to give you that security and safety that the bond market had years ago that you can also make passive income off today. And then the third category in my portfolio funds are the high risk, high reward. These are what I consider growth ETFs. These are ones that are mostly tech companies, because tech companies, AI companies, semiconductors, things like that, they are all growing at a rate that is much faster than traditional companies. For these, I personally invest in QQQ from Invesco, but you can also do QQQM, which is the same thing. It tracks the same companies, but typically has a lower market price, and it also has a lower expense ratio. You can also do SCHG from Charles Schwab. Again, there's tons of these out there. The biggest thing to remember though is don't chase the dividend ETF that has the highest yield, and don't chase the growth ETF that has the highest appreciation. There's always a reason. I mean, unless you're just wanting to risk that, that's fine. You know, always do what you think is best for your situation. But for me personally, I just think that there's a reason that they are so high, and I just don't trust it. For all of this, just, please don't just go off of my recommendations. Don't just listen to me or anybody else on the internet. Investing is very personal. Please, please, please do your own due diligence and your own research. And not guaranteed to make money in the stock market. In fact, you're guaranteed to lose money at some point. Just remember that. Let me know what ETFs are in your portfolio, or if you're just getting started. If you found this video helpful, you can follow me for more investing tips and tricks. And I also have a free weekly newsletter where I go more in depth into all these topics. You can go find that at substack.com and search Building Quiet Wealth.